Welcome. We are doing a CASNEB CPA question. The question is financial reporting and analysis, November 2015, question 3. The question is about conversion of a partnership into a company. Conversion of a partnership into a company. But before we start, I'd like to say that if you are interested in revising ahead of us, we have done all the questions from 2015 to 23 for financial reporting. I'll drop the link below. You can visit that website and buy those questions and answers at only cash 300. So now let us begin by reading this question. Amu and Bara are equal partners in a firm that buys and sells jewelry. The financial year end of the business is that one December. On April 2014, they converted the partnership into a company, Abara Limited. The trial balance as at that 1st December 2014 was given as follows. We have sales, purchases, discount allowed, bad debts, rent, salaries, distribution expenses, formation expenses, that is for the company, sundry expenses, capital, we have for capital for Amu, capital for Bala, trade payables, furniture and fittings, motor vehicles, inventory as at 1st January 2014, trade receivable, cash at bank, drawings, we have for Amu and Bala. Then you have your additional information. Number one, the partners have not made any changes to reflect the conversion of the partnership into a company. Number two, the sales and purchases accrued in the ratio of 20% and 80% for the partnership and the company respectively during the year. Discount allowed are to be apportioned in accordance with sales. Other expenses accrued evenly unless stated otherwise. All the bad debts were written off in the last 9 months of the year. Depreciation per annum is to be provided using the reducing balance method as follows. We have partnership and then we have the company. Furniture and fittings, 10%. For the company is 12%. Motor vehicles, 20%. For the company, it is 18%. Included in the motor vehicles balance, in the trial balance, is a purchase of motor vehicle for shilling 700,000 on 1st May 2014. Inventory as at 31st December 2014 was valued at shillings 20,825,000. Adbara withdrew shillings 600,000 and shillings 1,300,000 respectively in the quarter ended 31st March 2014. They are entitled to director salary of shillings 1,800,000 each per annum. The company issued 200,000 ordinary shares of shillings 150 each in settlement of the purchase of the assets and liabilities of the partnership. Required. A, we are required to come up with the income statement in column format for the partnership and the company for the year ended that 1st December 2014. B, statement of financial position for the company as at that 1st December 2014. Therefore, we can quickly start with the the income statement. We can start with the income statement. And when we start with the income statement, we have Ambala and Ambala Limited income statement for the year ended that 1st December 2014. We are now starting to answer the question. We have the sales. In the additional information number 2, you are told that sales and purchases accrued in the ratio of 20% and 80% for the partnership and company respectively during the year. So we are going to take our sales, which is 77,025. Remember, our figures they are in thousands. So this one, we apportion it in the ratio of 20% is to 80%. So we take 77,025 multiplied by 20%. I'm getting 15. Here you get your sales for the partnership are coming to 15,405, 15,405, and for the company now they're coming to 61,620. Then we go to purchases. How much is the purchases? 57,000. We apportion it in the ratio of 20% is to 80%. 57,000. And if you do that, 57,000 in the ratio of 20, getting 11,400. We are going to deduct purchases because purchases is part of the cost of sales. And then for the company, they are coming to 45,600. 45,600. We apportion the closing inventory, the opening inventory first. And how much was the opening inventory? The opening inventory was 25,000. We apportion it in the ratio of 20% is to 80%. And 25,000 times 20%, I'm getting 5,000. Opening inventory is 5,000 for the partnership, which means for the company it is 20,000. 20,000. Then we go to the closing inventory. How much is the closing inventory? Is 2825. So 2825 times 20%, I'm getting 4,165. So the closing inventory, we are adding it, 4,165, and for the company it is 16,660. 16,660. So at that point, we calculate our gross profit. We calculate our gross profit. And for the partnership, if I I take 15,404 minus 11,400 minus 5,000 plus 4,165. I'm getting 3,170 as a gross profit. And for the company, I'm getting 12,680. I'm getting 12,680. You can confirm that from your calculator. I encourage you to be having a calculator where we are going through this question. Then we go to the expenses. We start with the discount allowed. The discount allowed was to be apportioned in the ratio of 20% is to 80. We have that information at additional information number 3. Discount allowed are to be apportioned in accordance with sales, while other expenses accrued evenly unless stated otherwise. So discount allowed, how much is it? The discount allowed is 1,600. So we get 20% of 1,600. I'm getting 320. We are getting 320. And for the company, we are getting 1280. For the company, we are getting 1280. Then we go to the rent. How much is the rent? The rent is 1,800. Now, the rent is part of other expenses. So other expenses accrued evenly. That means we have to check the time when the partnership was dissolved, so that we check. On April 2014, they converted the partnership into a company, and their year was ending at 31st December. So on 1st April 2014, it therefore means that the partnership existed for 3 months. That is January, February, and March, where the company now, this new company called Abara Limited that is being formed, it will exist. It will exist for 9 months in the current accounting period. Of course, from there it will continue to exist. But remember, accounting we do it for 1 year. That is 12 months. So the partnership existed for 3 months, while the company existed for 9 months. Therefore, the other expenses such as rent, we have 1,800. We are going to apportion it. We are going to apportion it in accordance to the number of months it existed. Therefore, we take the rent, this rent of 1,800, we multiply by 3 out of 12 because it existed for 3 months out of 12 months. So 3 out of 12 multiplied by 1,800. I'm getting 450 for rent. I'm getting 450. And the other one is 1,350. The other one I'm getting 1,350. 1,350. Then we have salaries. Salaries, we have 5,400 multiplied by 3 out of 12. 5,400 multiplied by 3 out of 12. I'm getting 1,350 for the partnership. That 1,350 for the partnership, and for the company, I'm getting 4,050. For the company, I'm getting 4,050. and 50. Then I go to the distribution expenses. How much are the distribution expenses? They are 600. The distribution expenses are 600. So 600 times 9 out of 12. I'm getting for fifth. 600 times 3 out of 12. I'm getting 150 for the partnership. 150 for the partnership. And now 600 times 9 out of 12. I'm getting 450 for the company. Getting 450 for the company. Now we go to the sundry expenses. Sundry expenses, we have 950. We have 950 times 3 out of 12. I'm getting 237.5. 237.5. And for the company, I'm getting 712.5. Getting 712.5. Then we go to depreciation. Depreciation, that is an expense which was otherwise stated, so we have to calculate it. Depreciation. What are we told about depreciation? Depreciation per annum is to be provided using the reducing balance method as follows. Furniture and fittings, 10%, but the company is doing it at 12%. Motor vehicles, 20%, but the company is doing it at 18%. Included in the motor vehicles balance, in the trial balance, is a purchase of motor vehicle for shillings 700,000 on 1st May 2014. We have to take this into account. This we have to take it into the account. We have to deduct it from the total number of from the book value of the motor vehicle when we are doing depreciation for the partnership. We have to deduct it because this now motor vehicle was bought by the company, not by the partners. Let me show you how we will do it. We start with the depreciation of furniture and fittings. We are going to do that in working note number 1. Depreciation of furniture and fitting for the partnership. It is 10% out of 100. 10%, that is 10 out of 100. Then we multiply by the number of the months, that is 3 out of 12, because the partnership existed only for 3 months during the year. Then we multiply by how much is the furniture from the trial balance. Furniture and fittings, 2,400. multiply by 2,400. And if you do that, I'm getting 60. I'm getting 60. Our figure are in thousands. Depreciation of motor vehicle for the partnership. The depreciation for motor vehicle, it is at the rate of 20%. So here we are going to take 20%, that is 20 out of 100. Then we multiply by 3 out of 12, the number of months that the partnership existed during the year. Then you multiply by what is the value of the motor vehicle in the trial balance. Motor vehicles are 2,800. 2,800. We deduct this motor vehicle that was bought by the company. So 2,800, I deduct 700, and then the balance, that is what I'm going to multiply by 3 out of 12 and multiply it again by 20 out of 100. And if I do that, I'm getting 105. So the total depreciation for the partnership, it will be this 60. I add 105. So 60, we add 60, we add 105. And if I do that, I'm getting 165. 165. Then we go to the depreciation of furniture and fitting for the company now. So the depreciation rate is still 10%. 10, no. The depreciation rate of furniture and fitting for the company, let us check it. The depreciation rate is 12% for the furniture and fittings. That is the depreciation rate for the company. And the depreciation rate for motor vehicle is 18% for the company. So that is the rate we are going to use. So we take 12 out of 100. We multiply by the number of the months that the company existed during the year, only that one year. That is 9 out of 12. And then we multiply it by 2,400. And if I do that, I'm getting 216. Then we go to the depreciation of motor vehicles for the company. Remember, there was a motor vehicle which was bought on, included in motor vehicle balance. In the trial balance is a purchase of vehicle for shilling 700 on 1st May 2014. So here we are going to take 18. That is the depreciation rate of motor vehicle, 18 out of 100. We still multiply by 9 out of 12. 9 out of 12. Remember, when in most accounting, during the year of purchase, the asset is given a full year depreciation, and during the year of disposal, the asset is usually not depreciated. So we multiply by 2,800. And if I do that, I'm getting 378. So the total depreciation for the company now, it is 216 plus 216 plus 378. And if you do that, we are getting 594 as a total depreciation to be included in the income statement of the company. So our depreciation in the working one, we have seen for the partnership, it is 165, 165. And the depreciation for the company, we have seen it is 594, 594. Um, we have the bad debts. We have the bad debts. There's something we are told about the bad debts. We are, in addition information number 4, we are told that all the bad debts were written off in the last 9 months of the year. So that one, bad debts, all the bad debts were written in the last 9 months of the year. So they were written by the company. They were written off by the company. So that is 800. And then we have the director's salary. How much is the director's salaries? Uh, in addition information number 7, we are told that and Bara withdrew shillings 600,000 and 1,300,000 respectively in the quarter ended that 1st March 2014. They are entitled to director's salary of shillings 1,800,000 each per annum. So they are entitled to the director's salary of 1,800,000. So we take that 1,800,000 times 2. They are two directors. Remember, directors are the directors of a company. For partnership, we don't have directors, we have partners. So this salary of 36 of 3,600,000 is going to be apportioned uh, in the term by the term in which the company existed. The company existed for 9 months during that accounting period. So we multiply that 600 by 9 out of 12. And if you do that, you are getting your director salary for the period was 2 million. The director salary was 2,700,000. 2,700,000. And then you have the formation expenses. The formation expenses are for the company only. Let us write there, the formation expenses are for the company. How much was the formation expenses from the trial balance? We check in the trial balance, the formation, how much is the formation expenses? The formation expenses 240, so we deduct 240 there. Deduct 240. And at this point, we are now going to get our profit. we are now going to get our profit. So if you take 3,170, you deduct all these expenses, I'm getting the profit as 497.5. 497.5 as a profit. And for the company, I'm getting 503. I'm getting 503.5. Remember, when you get the profit for the partnership, you have to appropriate. You have to appropriate or apportion this profit among the partners in their profit sharing ratio. How are they sharing the profit? Am and Bar are equal partners in a firm that buy and sell jewelry. They are equal partners, so they were sharing their profit in the ratio of 1:1. They were sharing their profit equally. So we share this profit equally. 497.5 we divide by 2. You can see that Amu got a profit share of 248.75, while Bara got a profit share of 248.75. Of course, if you share their profit, if they share their profit, you remain with nil balance. And at that point, we are now done with the income statement. We are now done with the first requirement, where we were required to come up with the income statement. Where we were required to come up with the income statement. Now, we go to the statement, the second requirement, statement of financial position for the company as at 31st December 2014. Statement of financial position for the company as at 31st December 2014. And at that point, we must first work out the goodwill. And remember, we must first work out the goodwill when the partners converted this partnership into a company. And the goodwill is their capital balance at the time of conversion. You take the purchase consideration, you deduct their capital balance at the time of conversion. So we check what was their capital, at the time of conversion. Their capital at the time of conversion in the trial balance. You can see that the capital of Amu was 18,000, while Bara was 13,000. So the capital of Amu is 18,000, or the capital for Bara is 13,000. And if you add the total capital, you're going to get 31,000. But remember, at that time, they shared the profit, as we have seen in the income statement. They shared a profit before they must share this profit before converting the partnership into a company. So we give them their profit of 248.75. We also give this one his 248.75, and the total of the profit is 497.5. Then we have the drawings. The drawings we are going to take are the drawing from January to that first March, January to that first March, because they converted this partnership in 1st April. And we are told in the additional information number 7, Amu and Bara withdrew 600,000 and 1,300,000 respectively in the quarter ended that 1st March 2014. So these are the drawings by the partnership. These are the drawing by the partnership, because in the trial balance, you have the total drawing as for Am is 2,700, for Bara is 2,300. It therefore means that in the first, during the partnership period, that is from January to March, they withdrew this amount. So this is the amount that was withdrawn by the partnership. Then the rest was withdrawn when they had already when they had already converted the partnership into a company. So we deduct these drawings to get the capital balance. So we deduct these drawings. For Amu, it is 600, while for Bala, it is 1,300. The total drawings are 1,900. So if we deduct this, I'm getting the capital balance of Amu as 17,648.75. I'm also getting the capital balance of Bara as 11,948.75. You can confirm that from your calculator. And the total capital balance is 29,597.5. That is the total capital balance. So now we take the purchase consideration. Let's look how much was the purchase consideration. The company issued 200,000 ordinary shares of shillings 150 each in settlement of the purchase of the asset and liabilities of the partnership. Therefore, this is the purchase consideration. So the purchase consideration is 200,000. Remember, our working are in thousand, so we are going to take 200,000. Then we are going to take 200. We multiply by 150. 200 we multiply by 150, and if you do that, you get your purchase consideration as 30,000. That is the purchase consideration. Their capital balance is 29,597.5, and the purchase consideration is 30. The purchase consideration is 30,000. So we take this purchase consideration and we deduct the net asset acquired. Remember, the net asset acquired is the capital balance. The net asset acquired is the capital balance, because remember, capital is an, why are you saying capital is a net asset? Because capital is given by asset minus liabilities. And the net asset is just assets minus liabilities. Okay, that is fixed asset plus current asset minus long-term liability minus current liabilities. So we deduct this capital balance of 29,597.5. And if we deduct the capital balance, we are getting the goodwill as 402.5. We are getting the goodwill as 402.5. Then we have another working to do of the drawings. The total drawings, we have another working to do for the drawings because the total drawings, that is from the trial balance, the total drawings for arm is 2,700 and for bara is 2,300. So the total drawings for arm it is 2,700 and for bara it is 2,300. We have now we are working the drawings for the company now. The drawings, we are working for the drawing for the company. And so we deduct, these are the total drawing for the whole year. We deduct the drawings for the partnership. AMU during the partnership period withdrew 600 and BARA 1,300. So drawings by the directors, now the company now, for AMU it is 2,100, and for BARA it is 1,000. Those are the drawings that AMU and BARA made during the company period. Therefore, what are we going to do with this drawing? Because remember, the directors are entitled to director salaries because the company and the owners, the company and the shareholder, where some of the shareholder become the directors, they are considered as separate legal entity. Therefore, we had been told that they were allowed a salary of 1,800. So this drawing are going to be converted into their salary, the salary that they were being given. They were given a salary of 1,800, that is 1.8 million per the director. So out of the 9 months, each director was allowed a salary of 13. So we deduct the salary that they were allowed. We see how much has they withdrawn from the company over their salary. How much have they withdrawn from the company in excess of their salary? So this one has his salary is 1,350. Also, this one is 1,350. This one is 1,350. So this one has withdrawn above his salary by 750, and this one has only withdrawn 1,000. So therefore, it means that the company still owes him 350. Therefore, the company owes Bara 350, while AMU owes the company 750. So therefore, this is going to be treated as accrued salary, and this one is going to be treated as prepaid salary. Prepaid salary. So finally, now we go to the statement of financial position. We have the furniture and fittings. Furniture and fittings, we have, there are 24. 2400, you deduct the depreciation by the partnership is 60 and by the company is 216 from our working note number 1. So we are getting the total as 2124. We are now in the statement of financial position, Abara Limited, financial position of the company, Abara Limited, statement of financial position. So now we have done have done non-current asset, we have done furniture and fittings. We go to motor vehicles. Motor vehicles there were 2,800. You deduct 105, that is the depreciation by the partnership, and then you deduct 378, that is the depreciation by the company. And if you do that, you are getting your book value as 2,317. Goodwill, we have done it in our working note number 2, goodwill 402.5, 402.5. So we add this, so the total non-current asset is 4,000. The total non-current asset is 4,843.5. 4,843.5. Then we go to the non-current asset. Non-current asset, we have inventory. The closing inventory, we are told it is 2825. 2825. You can check that in the additional information. The trade receivable 8,100, that is from the trade balance. The cash at bank, how much is the cash at bank? From trade receivable is 8,100. Cash at bank is 5,635. 5,635. 5,635. Then we have prepaid salary to AMU. The prepaid salary, this one we have calculated here, is 750. Prepaid salary is 750 because AMU has taken more money, has withdrawn more money from the company. Therefore, that is treated as prepaid salary, 750, which means that in the next year, when he is going to be getting his 1,800,000, they are going to deduct this 750,000. They are going to deduct this 750,000 there. So the total current liabilities, the total current liabilities is coming to 35,310. 35,310. So current liability plus non-current liabilities, we get the total of assets. I'm getting 40. Just put this one in bold. I'm getting 40, 153.5. 40, 153.5. Then we go to the equity and liabilities. Equity, we start with ordinary shares. Ordinary shares. We have done that in this when we are calculating our goodwill purchase consideration, ordinary shares, 200,000 times 150, we got 30,000. Or we can check that information in the additional information. The company issued 200,000 ordinary shares of shillings 150 each. Therefore, ordinary shares is 150 multiplied by 200,000. So 150 multiplied by 200,000, which we are getting our ordinary shares as 30,000. 30,000 because this one is in thousand. It is in thousand. Because if you take 200,000, you multiply by 150, you are getting 30 million. So you divide by 1,000 to put your figure in 1,000, you're getting 30,000. We had already done that. Just remove that one from board. Then we have profit from our income statement. Profit for the company is 503.5. 503.5, and therefore the total for the equity is 503.5. 503.5. We finally go to the current liabilities. We finally go to the current liabilities. And for the current liabilities, we have trade payables from the trade balance. How much is the trade payable from the trade balance? The trade payables is 9,300. 9,300. Then the salary, there's a balance of salary that we have not paid to Bara of 350. We still, as a company, the company Bara Limited, the company still owes Bara Limited 350,000. So that is accrued salary of 350. And if you do that, you get your current liabilities. You get your current liabilities as 9,650. We add the equity 9,650. You add 503.5, and you are getting 4153.5. You can see your statement of financial position has balanced, which means you have done that question correctly, which means you have done that question correctly. 153. Remember to buy all the answers to financial reporting past paper from the link below. And if you have any question about those answers, or about this question, you can post it there below, or reach us through the email which is in those past papers, and answers. They are going for only cash 300. Thank you very much, and I'll see you in the next